welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If you want to know what Donald Trump cares about above all else, it is investment in the United States. As it relates to AI, there was a rule out by Joe Biden just last week that wanted to keep it even more in the United States, make sure the chips stay here. I expect that rule to stay because if we can keep AI in the United States, that is a national security prerogative and a big boost to the US economy.
The ad tier was introduced because the company recognized that as they kept raising price, the ad-free tier was already the most expensive streaming service and, was going to remain there. So they wanted to offer a lower priced option. I think that, this exceeded their wildest dreams. What it allowed them to do was talk people who quit into trading down to an ad-supported tier.
We know there's a lot of cash on the sidelines, and when we get days like today, this great strong day, a lot of investors again will say to themselves, well, let me wait, maybe I missed it. But one of the big things we're seeing it today and really over the last day or two is that the market that was a little bit sideways the beginning of this year with uncertainty is now breaking out. It's moving higher.
We got 1 hour to go until the market close. Taking a look at the major averages, seeing more of a rally here. The rallying continue. We see the Dow up about 157 points, 0.4%. The S&P 500 getting close to a closing record here, up 0.75%, and the Nasdaq up 1.4% as well. So the sort of optimistic tone continuing in the markets.
Yeah, a couple of themes. Say one, listen, earnings season rolls on. We've had some names reporting, Julie, who have, gotten some very nice receptions.
Netflix, for example.
Netflix, Rockstar, now up about 100% in the past 12 months. Saw Procter & Gamble reported there in the green today, too. So that's one, earnings season perhaps providing some comfort, but of course also Stargate. Come on, you got to talk about the big AI project.
Yes, so let's talk about the big AI project because it's affecting a lot of the large cap tech names here today. Stargate, this $100 billion promised investment in AI infrastructure in the United States. The announcement made yesterday at the White House with OpenAI, with SoftBank, and Oracle. Sorry, I'm forgetting all three names.
It's a lot of big names.
A lot of big names, but they also talked about a lot of other names that are going to be helping, like NVIDIA, like Microsoft. Those stocks are also rising today as part of this big announcement. And maybe I can equal weight it here so that we can find where Oracle is on this board. Is Oracle not in the Nasdaq 100 anymore?
It should be.
I guess, I don't know.
Someone tell Larry Ellison
here today. In any case, it's also getting a big boost today.
It's big headlines, it's big numbers, it's hundreds of billions of dollars, and so lots of excitement and investors are placing their bets. Will the reality actually meet the hype, Julie? We wait and see. Of course, another interesting thread, and we were talking about in the newsroom, is a very basic one of whether you can actually secure the financing for all these dreams. And there's been some big personalities kind of pushing back on that. Elon Musk was on X, going after SoftBank, saying no, they can't afford to do this.
Right.
And you had Sam Altman going right back at him and saying that's not true.
Yes,
so
and people familiar with the situation at SoftBank saying that indeed they said it seemed like that Musk kind of pulled out that $10 billion number from thin air, and that they do indeed have plenty of funding in order to finance this project.
I guess regardless, bottom line, it's given this another lift to that mega AI trend that has helped power the market that we've talked so much about. All right, stocks higher in the second full day of trading in the Donald Trump 2.0 era. And our first guest today says while there are plenty of risks ahead for markets, U.S. exceptionalism remains well intact. Timothy Chubb, Gerard Advisory Services Executive Vice President and Chief Investment Officer. Tim, it's good to see you. So let's start right there, Tim. You say, of course, plenty of uncertainty, but U.S. exceptionalism, that's the story, that's intact. What do you mean by that, Tim, exactly? What do you mean by that? What does it mean for investors?
Yeah, absolutely. And thanks for having me. I really, one of the key themes to our outlook was that US exceptionalism, and ultimately growth in the United States is expected to be quite a bit higher than the rest of the global economy. Despite what's going on and some of the uncertainty with tariffs and some of the other geopolitical risk out there. Ultimately, taking that aside, the European economy is struggling, the Chinese economy is struggling. They're not able to innovate in Europe. There's lots of long-term structural related issues within China related to debt as well as demographics. And ultimately, I think it's going to kind of go back to the pre-global financial crisis, or excuse me, post-global financial crisis, ZERP area of, the US being the cleanest shirt in a pile of dirty laundry for growth. And as you just, let in, AI is a big part of that story. And so ultimately, helping fuel growth, not just for profits of the S&P 500, for the broader economy as we start to get some of those productivity gains really starting to filter in some of the economic data.
So Tim, where do you go then to benefit, from this growth that we could continue to see? Do you go to places like, this AI infrastructure play, for example?
Most definitely. We're really in the early innings of that. We talk about it a lot in the context of a baseball game. I remember, years of where are we at in cloud? We're still in the very early innings of AI adoption. And in fact, I think 2025, may be a really key year for more enterprise adoption. As we saw ChatGPT get released, users, were largely consumers, and to the extent that we'll see more and more companies incorporate generative AI into their business, I think is really a critical year. And that goes beyond just the hyperscalers. It's ultimately how businesses can look to find some efficiencies. And taking some of the data that they may have in a core system, say like Salesforce, and ultimately getting some new insights from that. And so I do think that we're going to start to see some of the ROI from some of these AI investments start to materialize in the back half of this year. And that has us really focused on a variety of areas, from the hyperscalers and the Mag 7, which we very much like, but even more broadly in a company like Synopsys on the design side, as well as the infrastructure, companies on the industrial side of things like an MCore, which ultimately need to helpful to enable some of that infrastructure to build out.
I want to touch on a point you just made there, Tim, because listen, with this Stargate AI project, you can obviously understand the excitement. I mean, it is big headlines, it's big personalities, it's a ton of money. I mean, $500 billion being floated out there. And you can see investors today, Tim, they're placing their bets, Microsoft higher, Oracle's higher, they're bidding up NVIDIA. What's interesting though, Tim, is the point you just made is it wasn't so long ago, I felt like we were also having this conversation, Tim, of investors maybe increasingly maybe not feeling cautious, but certainly having questions about all this AI spend. Spend. Where is the return?
Yeah.
Have we moved past that?
I think so in a lot of ways. Certainly the hyperscaler spend really came out of nowhere, right? I mean, 200, 300, the numbers continue to grow, and it really seems that that spend is durable. I mean, we're talking about companies with rock solid balance sheets, with an abundant amount of free cash flow, that really don't want to be left behind in this new generation. And so I think what we're seeing is the spend is durable because it's a lot of incumbents within the technology sector that are really well positioned to continue building on their existing ecosystem. And a perfect example of that, and sort of the timeline from an ROI standpoint, I think is Meta. Ultimately, AI and some of the tools that they would be able to incorporate to ultimately enhance their ad impressions and likely the spend, especially in the context of what's going on with TikTok, really has us excited. And so I do think the spend is durable. We'll broaden out a bit later in the year, and perhaps NVIDIA has less customer concentration than they do right now. I'm not so sure that'll be the case. But ultimately, I think we're still very much in the early innings, and I think you can look more broadly to the AI story, as we saw last quarter with Broadcom, for example, on the custom side of things, to continue propelling this bull market forward.
Tim, when we talk about the AI play, when we talk about the Magnificent Seven, I know there is one exception that you guys are not as interested in. That is Tesla. Why not?
Yeah, with Tesla, it's gosh, I probably could sit here for hours and talk about it. Unfortunately, we still have a car company, and a car company with a lot of promises and operating margins close to 10%. And I know there's a lot of excitement about autonomous, but going back to the capital that you just discussed related to the whole AI build out, where does the capital come from to build a fleet of $60,000, $70,000 Teslas out there driving everybody around? not to mention, Waymo is so much further along with their ambitions related to autonomous driving. And so one of our favorite picks for this year is Uber for that reason. It sold off towards the end of last year. Ultimately, there's a bit of normalization taking place within earnings, but ultimately, net income is expected to grow quite a bit in the next couple of years after so long. The company competing with, Lyft, for example, and trying to gain market share. It now is the dominant player. They have economies of scale. And I think, those partnerships with Waymo and Tesla and others on the AI front really put Uber in a really strong position to continue to really take the autonomous vehicle, sort of narrative to real life and application as we likely see later in this decade.
Tim, just on Tesla, one quick question was, we had folks come on the show, Tim, and at least part of their bullishness was the fact that Musk had become so close to Trump, right? I mean, and you've seen these recent reports. Musk might be getting his own West Wing office. So I'm just curious. Obviously, you can't model a relationship, but the fact that Musk is that close now to the president of the United States, does that give you pause on Tesla?
It doesn't. We saw this with the prior, when Trump was in office previously. The cabinet comes and goes. And, to me, that's not a good enough of an investment thesis. And I realize, and hope that Elon's, efforts within Department, of Efficiency ultimately are successful in starting to bring down our fiscal deficit. But I'm skeptical he's going to be successful in some of those efforts. And I'm also skeptical that, he'll be around this time next year, having the influence that he may on the administration. So at the end of the day, it's not necessarily a huge, we don't like it for a lot of fundamental reasons, but, we're long-term investors, and that's not a durable enough investment thesis for us to be interested in a car company.
Yeah, and to your point, today he was out there sort of throwing some shade on this Stargate announcement. So we'll see what happens. Tim, always great to see you. Thanks very much.
Yeah. Thank you.
We're just getting started here on Market Domination. Coming up, we'll get you out to Davos, Switzerland as the 2025 World Economic Forum rolls on. Yahoo Finance's Brian Sozzi and Jennifer Schonberger will be sitting down with executives and experts across a host of industries. You can scan the QR code below to check out all of Yahoo Finance's coverage throughout the week. Stick around in the meantime, much more Market Domination still to come. Now that President Trump's second term is underway, sweeping changes may be in store for several federal agencies. One of Trump's first moves was appointing FDIC Vice Chair Travis Hill to lead the agency on an acting basis. Hill, who's also widely seen as the top contender for the job permanently, has served as the FDIC's Vice Chair since 2023. Joining us now, Sheila Bair, former chair of the FDIC, among many other hats she has worn. Sheila, it's always good to see you. The FDIC is coming off of sort of a tumultuous period from a cultural perspective within the agency. So what do you think of this Travis Hill pick, even on an acting basis, to sort of take the FDIC into this next Trump era?
So it's really uncertain. I think it's worth noting that Travis Hill just automatically becomes chair. He's the vice chair. Marty Bloomberg stepped down on the 19th, so he automatically became chair. It didn't really require an appointment by Mr. Trump. And I agree, it seems like he is an obvious contender for that job. There are a few other names that are out there. I do think whoever takes the helm, there are some important issues that need to be dealt with, that we saw some problems with the resolution planning and execution, clearly need to be addressed. But more importantly is FDIC employee staff morale, and the culture and the lack of accountability and leadership to impose accountability and protect people who were subject to some pretty bad behavior, according to press reports. So I was disappointed. Mr. Hill has put out a couple of statements now about his priorities. He's really not. His first speech didn't say anything about cultural morale, and his second list of priorities had it way down at the bottom. So that was a bit disappointing. And I hope, to the extent he is there for a time as acting or perhaps as permanent, that he think about that a bit, because the FDIC is an important operational agency. It handles bank failures, and it's imperative that those be handled smoothly and quickly and cleanly and in a way that is reassuring to insured depositors. So making sure, even if you don't care about FDIC employees, which I hope he does, I certainly did, their morale is important to the effective functioning of that agency.
How, Sheila, the FDIC reviews proposed banking mergers. It sounds like Mr. Hill wants to review and revisit that. In your opinion, should that be a priority?
Yeah, well, I agree with him on that. I oppose this previous policy. That just, blocking regional banks or putting extra scrutiny on any bank over 100 billion or merger that would result in a bank that size. It was just going to create a bigger moat around these too big to fail banks. So no, the best way to provide some competition for them and maybe some competitive pressure to downsize is by letting the regionals get a bit bigger with more resources, especially for marketing, which is a real key strength of the mega banks. So I think he's right on that. I hope so. Whoever the permanent chairman is, I hope that's their view. And I think there's going to be more M&A activity among the smaller banks this year.
Sheila, is the FDIC appropriately sized to deal with maybe an uptick in M&A? Because as we know, not only do they have this new leader, but there is, of course, DOGE that may be training its sights across a host of government agencies.
Right.
I think the FDIC has something like 6,000 employees. What do you think is going to happen in terms of sort of modernization and rationalization within the agency?
Well, the FDIC is a management challenge because it needs to be prepared operationally. These bank failures come in waves and cycles. And so if you're going to downsize significantly during the benign periods, you're going to have a problem when the next uptick in bank failures comes. And that's exactly the problem that I had when the FDIC had gone through some very severe downsizing. About a third of the task force, the employee workforce had been let go. And then we were right at the beginnings when I came there. Signs of the crisis were already emerging, and we had to change course and hire quickly. So I think they need to be cognizant of that. Some of that you can backfill with contracting. We brought in some retired employees. We got permission to do that. So there are ways to management so you don't have to maintain this huge workforce, but you can only downsize for so much without compromising the FDIC's preparedness to handle bank failures.
I'm sorry, Sheila, go ahead.
They have huge supervisory responsibilities too. They are the federal regulator for thousands of community banks that are state chartered but not members of the Federal Reserve. So that examiner task force, these are smaller banks, but there's thousands of them. And you need to visit a bank. You can only do so much remotely, and to be a good examiner, you need to visit a bank. So that requires a lot of personnel too, and travel time.
Yeah, Sheila, sticking with DOGE, Department of Government Efficiency, it sounds like the mandate there, Sheila, is really, it sounds like focused on kind of upgrading government IT systems, right? That's going to be a big focus.
Yeah.
Given your experience, your resume, Sheila, how, in your opinion, a worthwhile effort?
Yeah, I do. I mean, I think I'm also on the board of the Volcker Alliance, where this is, and the Volcker Alliance is all about good government. And this is something the Volcker Alliance has been looking at. And I think, I don't speak for them, but I think it's safe to say they're generally supportive of that. So yeah, I mean, I think you could improve a lot of efficiency, contain costs in a good way without sacrificing services to taxpayers who they pay the taxes, they also benefit from the services. So yeah, I think their expertise in that area is very promising, and I hope they can. That's been a challenge for government regulators in the past. So all government agencies, just they don't have their own expertise internally to oversee those kinds of upgrade projects. And then the resources are not always there, or especially the ones that are appropriated, the budget certainty of having the ability to upgrade, because those are typically multi-year commitments, and that has been an issue in the past as well.
Sheila, one other matter that may be shifting in Washington is the fate of Fannie Mae. I believe you were on the board of directors there, not currently, but so you have some expertise. What do you think happens there, and what do you think should happen there in terms of whether it should be fully privatized?
So I was chair of the Fannie Mae board under Mark Calabria, where a lot of we thought we were going to exit. That was one of the reasons I joined the board and became chair, because I thought we were going to exit, which I think needs to happen. And a lot of the preparation work had already been done. And then, of course, the election happened, and there was a complete shift in priorities. But look, it's 14, 15 years. Come on. That is far too long for any financial institution or any institution to be in a government-run conservatorship. And I think we're lucky that kind of the inhibition that comes with that kind of heavy government oversight. It hurts agility, it hurts decision making, it hurts the ability to bring in top talent, to get the tech that you need. So it does need to be privatized, and it's also just it needs to be on its own too. I don't support these people that say, oh, well, it needs an explicit government guarantee. All their securities need an explicit government guarantee. That's not a good idea. Didn't have it before conservatorship, shouldn't have it now. We need some market discipline with them, and we need much stronger capital requirements, which we already have through FHFA. So yeah, they need to exit. That's probably going to be a multi-year process. I think it can be done administratively. I don't think they need legislation. They need legislation for an explicit guarantee, but that would be very market distorting, a terrible idea, not necessary. And so I hope I thought Trump 1 was going to do it. Hopefully Trump 2 will do it.
Well,
now.
and Sheila, quickly, how do you do it without reducing the availability of mortgages to sort of lower income folks who get it via Fannie and Freddie?
Well, that's been a common argument against it. I don't think so. First of all, you have FHA, so we have a program specifically in Ginny, specifically for low-income people, and then obviously the GSEs should also. Any mortgage lender should be sensitive and inclusive in mortgage finance being available to people who can afford a mortgage. And but we don't do them any favors by giving mortgages they can't afford, which is exactly what happened during the great financial crisis. So I don't see that those functions being compromised at all. Actually, a guy named Michael Calhoun, who is the head of the Center for Responsible Lending, he worked on a Brookings report that laid out a path for exit that addressed those issues as well. And I'm sure that's going to be in the mix. So I don't think even the affordable housing group is necessarily hostile to exit. But I think those kinds of, in the right way, those kinds of obligations to serve all people who can qualify for a mortgage and again afford their mortgage, which is what we want for them.
Right.
I think that can be preserved. I don't worry about that.
Hopefully you are right. Sheila Bair, it's always so great to catch up with you. Thanks so much for your time. Sheila is former chair of the FDIC and also author the children's book series, Money Tales, which you can see
Thank you for mentioning
on the shelf right behind her. Thanks, Sheila.
There you go. Thank you. Bye-bye.
Now it's time for some of today's 10 trending tickers. You can scan the QR code below to check out the best and worst and most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, we've got to look at Johnson & Johnson. Now, those shares down about 2.6% despite beating on earnings. Yahoo Finance's Anjali Kamlani joins us now to discuss currency problems for J&J, it seems.
That's right. Foreign exchange was an issue for them, but there's more than that, actually. The company has been a little bit under pressure in recent months, partly because of their overseas efforts, including in China, medtech sales down there, and that is part of the pressure. But Stelara, the generic drug, also adding to the pressures, as well as the upcoming year. There's a lot going on for this company. So let's take a look at the numbers real quick. Total reported sales for the year, $88.8 billion. That is up 4.3% compared to 2023. And it would have been higher if not for the slowdown in vaccine sales, COVID-19 vaccine sales, but we've seen that across the board. Meanwhile, for the quarter, $22 billion in sales, up 5.3% year over year. Good numbers there. Now, the talc lawsuit is another big one that's weighing on the company stock. Investors are kind of finicky about whether or not, J&J can get it off the books and in a good place by the end of the first half, and that is what the management said today. We had a chance to catch up with CFO Joe Woken. He told me on a call earlier today that while talc is risky, they do believe that they can cover it with the financial resources that they do have, whatever that number is at the end of the day. In addition, they're also looking at the Stelara competition, so that generic competition. They're taking a book out of AbbVie's Humira page and looking at how, Humira kind of had a good market share, retained 96% market share within the first year. And so they're thinking that they can also pull off kind of the same look and don't think that it's a problem. So even though investors seem to be a little bit skittish, despite the beat on earnings, they are signaling that they're pretty bullish for the year ahead.
Right. We'll see if investors come around to that at some point. Thanks.
Thank you, Anj. Next, let's look at shares of Amazon, as that company reportedly is exiting its operations in Quebec, cutting more than 1,700 jobs. So Amazon shutting down warehouses in Quebec, Julie. I saw reports laying off around 1,900 workers. Apparently, we use some subcontractors instead there, companies saying to press. We have seen that returning to a third-party delivery model supported by local small businesses, similar to what we had until 2020, will allow us to provide the same great service. Just to put that, roughly 1,900 in perspective, the company had around 1.5 million employees at the end of 2023.
Yeah, so is this the reason that the stock is up today? Probably not, but there is definitely a momentum case to be made here. And in fact, Amazon is on track for a record close today. So that is worth mentioning as well. Analysts are overwhelmingly bullish on Amazon for this year. 94% of the analysts who rate this thing, according to Bloomberg, rated a buy, as you see
That's
there.
a lot of love.
And the stock's up over 50% over the past year. And we've talked to a number of analysts who cover it who say it's like their top pick going into this year, or one of their top picks. So there's just seems to be a lot of enthusiasm around Amazon right now.
You always taught about the value of being contrarian. But you know what? The herd can be right too.
Yeah.
Why not?
Well, you know what? And one quick note on Amazon that's interesting in this current environment. We keep talking about Elon Musk and how he might benefit from closeness with the administration. We talk about Zuck also. We've talked less about Bezos and a direct benefit for Amazon, even though he obviously has also been more visibly supportive
for sure
of President Trump. So it's just been less part of the disc. I mean, his name has been mentioned.
Yeah.
There's been less
bit rocky
dwelling
in
on
Trump 1.0, but
yes,
Trump 2.0 has started. New day.
Yes.
Lastly, a look at shares of Textron as the company delivers a beat on earnings, but outlook for the year missing the street's expectations. So this one, manufacturer of Cessna aircraft, Bell helicopters. It does sound like this was a disappointing profit forecast for 2025. Q4 revenue missed. And it did sound, Julie, like a strike at its aviation unit. had an impact here.
Yeah, the company also makes power sports. I didn't know this power sports product line, but it's doing a strategic review of that it announced in December. So that's something that's still going on. And then this stuck out to me from the conference call today. The CEO, Scott Donnelly, was asked about tariffs, and he said the tariff is very much a wild card. He said, we don't know the specifics. They do have operations in Mexico, he pointed out, as well as in Canada. They make Bell helicopters partially in Canada. So he basically said, we don't know. And he said, we have to see how this plays out. So, I think a lot of companies are doing that right now that are in that position, these manufacturers who have operations probably in the United States and then north and south of the border to see what's going to happen with tariffs.
Street broadly bullish on this one, though. The stock has not done a whole lot over the past year. I mean, it's basically flat at this point. All right, all week long, Yahoo Finance is bringing you conversations from the World Economic Forum at Davos. Let's get you out to Brian Sozzi and Jennifer Schonberger for what investors need to be watching from the landmark event.
New day of coverage at the World Economic Forum here in Davos, Switzerland. I'm Yahoo Finance's executive editor, Brian Sozzi.
And I'm Jennifer Schonberger.
So Jen, lots of different places we can go with this one. I would say today, the focus has been a little bit of around the horn, at least for what I'm hearing. First up, I had a great chat on the Opening Bid podcast with noted economist Nora Robini. He made a case that humanoid robots will take jobs, which is kind of creepy as hell if you ask me.
I've seen robots in the streets here. They're doing demonstrations.
I saw a little dog. I took a photo. I think it was DHL, a little like robot dog.
Creepy.
It is creepy, but not creepy, I would say, or whatever it is. But PepsiCo CEO Ramon Laguarta talking about the future of his consumer products business, suggesting that he wants to work with the administration and be a friend as it pertains to food, health, and packaged good industries. So that was interesting, too. I got to reflect on that one a little bit more. And last but not least, I know you've been tracking this a lot. Talked to Ralph Lauren CEO Patrice Louvet about the impact of tariffs. And it's another retail CEO, Jen, that is reminding me that, yes, that they have a presence in China. There might be some tariff risk. But over the past 4 years, they have moved sourcing out of China ahead of potential any tariffs, whether it be from the Trump administration or whoever else had won the White House.
Yeah, you're hearing about the impact of tariffs more from the micro side, and I've been hearing about it more from the macro side. And this morning I heard from the Bank of France, the governor of the Bank of France, and he thinks that Trump's policies on tariffs and what he calls fiscal expansionary policy, translation tax cuts, could be inflationary. So he thinks there's a chance that inflation could reignite in the United States. Meanwhile, also listen to some very interesting perspectives on where future vulnerabilities are in the financial system that could pave the way for future crises. And the CEO of UBS is actually concerned about a government debt crisis, just given how much debt many countries are carrying at this point. If inflation remains buoyant, then that means interest rates could remain elevated and we could potentially see some defaults. He also interestingly said he's not sure that deregulation, something that we expect to see from the new Trump administration as pertains to banks, is necessarily a good thing. He thinks that banks should serve as a resolution during a crisis, not a problem.
I'm glad you're in all these panels. I know, Jen, you've been like working these rooms. You've been in these rooms throughout the whole trip.
I've gotten more insight, I think, over the last couple of days than I have in like the last 3 months.
No, I didn't want to tell you before we get out of here. I shook the hand of that robot dog. I have a photo and a video of it.
I gotta see this.
Like, does that make me weird? Like, is that weird? I mean,
no, it means you're experiencing the future of technology firsthand.
You know what? We're going to leave it there. Last word to you. We're going to drop that mic, really, Jennifer. I appreciate it. And again, tune into Yahoo Finance's coverage of the World Economic Forum all week long. We have a beautiful World Economic Forum hub on Yahoo Finance. Of course, you can follow us on our app, podcast platforms, all over the place. Tune in. You're going to learn a lot. No shortage of topics to hit at the World Economic Forum in Davos, Switzerland. Let's talk to Cisco CEO Chuck Robbins, always a regular guest for Yahoo Finance at WEF. How are you, sir?
Absolutely, I'm good. How are you?
I'm okay, I
cold?
think. Yeah, just a little nippy. What's not cold is the news cycle.
That's true.
That's actually pretty good. I came out with
that
on the fly. What's your sense? We're 3 days now into Trump administration. Is this administration as business friendly as many are led to believe?
Yes.
Really?
Yes.
How so? I mean, is it just cutting taxes and regulations and we're off to the races?
Well, I think if you think about the things that are really have been difficult, first of all, you got to do taxes this year because there's a lot of expiring, and if we don't do them, there's trillions of dollars in tax increases for the American citizens. So we got to get that done. And with Republican Congress, Republican White House, it's still going to be complicated, but it'll be easier than it would have been. So that's first. And we know where Trump stands on corporate tax rate and corporate competitiveness. And everything that we believe in is around pro-growth, which we think is good for the country, and Trump generally believes in the same thing. So regulation, you mentioned, financial services industry in particular, permitting, things of that nature. We think M&A will be much simpler now. I think we've heard a lot of the banks CEOs talking about how the activity is beginning to pick up. And then, we have the issue of tariffs that we have to just wait and see how they play out.
You're also head of the Business Roundtable. Is that one of your main topics when you talk to CEOs and then you go, I guess, talk to members of the administration? Is taxes top of mind for you this year
Yes.
to get that corporate tax rate? I mean, what is it now? Is it somewhat favorable or?
Oh yes,
or
21. It's good.
That's pretty good.
And we worked hard in 17 for that. But conditions are a little different now. This year, you've got the deficit, you've got interest rates, and so there are a lot more variables at play that are going to come into discussing what the actual tax package looks like. Our hope and desire is obviously to keep the rate where it is.
Can it go lower than 21%?
We would love to see it go lower than 21%, but we're also pragmatic about the broader situation that's going on with the tax package.
How concerned is the CEO community about rising deficits?
Very, very. I mean, when you contemplate the fact that we're actually spending more to service our debt than we are on our military, that's just a troubling statistic. And I think the business community appears to be more concerned about it than Washington does.
You think we're headed towards some form of day of reckoning?
If we don't do something about it. But I think growth can be very helpful for the deficit. I mean, if we can put pro-growth policies in place and really help our businesses thrive, help us create jobs and grow, then that's good for the economy and it'll help resolve the deficit over time.
How has it been like doing business the past 4 years? Has it been too tough regulation-wise?
Well, for Cisco, we didn't really have a lot of issues. There was very little engagement with the administration. There was some, obviously, like Commerce and Gina was always great and spent a lot of time with the business community. But for other industries, it was much tougher. So if I think about it from a BRT perspective, it was much more difficult than we anticipate it will be with this administration.
You do business in China. We've talked about this in the past. If there is a trade war, how much more difficult is your business in China get?
Our business is virtually immaterial at this point in China. So from that perspective, it's not a concern. I have always said that I feel like the world is a better place and the global economy is a better economy if the U.S. and China can figure out how to coexist. Now, there's certainly issues that need to be worked out, but I think, and so I'm optimistic that the Trump administration has actually made some outreach to try to have some conversations. I think that's the first place to start. Does
it make it more, this environment, this politically charged environment, more difficult to be a global company and a global leader? I imagine now you have to really move or think through a lot of different chess moves, chess pieces. Not that your job wasn't hard enough, but now it seems like, holy cow, it got even a lot harder.
It is, it's certainly more complicated, but you've got everything from data sovereignty to sovereign clouds to desire for local manufacturing. So every country has different priorities and are implementing different requirements for companies, which makes it, it makes it more difficult. It's more expensive. In many cases, it's inflationary for the country because the prices are higher when you bring services there. But we'll work through it. It is what it is.
I'm realizing I'm perhaps leaning too much into your business roundtable out here. On Cisco, we've talked a lot about AI orders. The street has given you high, marks for what you've been doing in AI. What does your AI order book look like?
Well, this is the last week of our quarter, so I'll let you know in 2.5 weeks.
Fair.
But as of the end of last quarter, we were well ahead of the linearity we would need for the target we set for the year, which was $1 billion from just from the web scale players.
How are companies using AI from Cisco?
Well, what we provide is the network infrastructure that connects the GPUs. We provide security. We provide enterprise stacks of tech that actually help them deploy AI more simply. We had a big announcement last week around AI defense, which actually gives them the ability to build guardrails around whatever models they're choosing to use. So we're out early on the security side of this. And I think this year is going to be the year we're going to see enterprises really deploy lots of applications. We were talking about contact center. Customer service is a real common application. But we think agentic AI this year will allow us to, I heard Benioff talking earlier about digital labor, and I think you could contemplate like the basic responsibilities of a network operations analyst being put into an agentic AI agent and actually doing that job.
But lastly, are you involved in Stargate at all? And when you see a press release like that come from this administration, do you think like, well, how can Cisco participate in building out AI infrastructure?
Well, I mean, we're not at this point, but I fully believe that we will have the opportunity to provide some of the technology underneath the NVIDIA clusters, because we're doing the same thing in the web scale players today. There's basically 3 companies that can actually deliver the high performance, low latency Ethernet that's required, and we're one of them. So we believe we'll get a good shot at it.
So nothing to announce yet, but perhaps there.
Hopefully in the future.
Okay. All right. Chuck Robbins, good to see you as always.
Good to see you.
Cisco CEO, have a great rest of the WEF. Appreciate it. All right. Do stick around. Much more ahead on Yahoo Finance.
Wall Street keeping a close eye on 2 key market movers, one of them being earnings season and the other President Donald Trump's policy actions. But how does this trickle down to the options market? David Bull, Baycrest Managing Director, joins us now to discuss in the Options Pit, sponsored by Tasty Trade. It's good to see you, sir. Let's talk about a couple areas that we talk a lot about on this show, David, and I want to get your thoughts on it. One would be small caps. We've had folks, David, for 12 months. I've had strategists come on the show and tell me small caps are the place to be. They would kind of give you different reasons for that. Often it was the economy's growing, expected earnings growth, relative, attractive valuation, David. But from your perspective, interested to get your take on the small caps. What do you see?
Well, there's been a big rally in small caps over the last week or so. And if you look at the big 3 indices and, in the US indices, small caps are the furthest away from the all-time highs relative to S&P and Nasdaq. So I was talking to clients last week about positioning for IWM upside. It's rallied essentially ahead of schedule. And now this move has gone so far, so fast. After this presidential inauguration, there's a predictable rally that happens in the market. Well, who knows if it's predictable, but the vibes are high when a new president gets sworn into the office. In each of the last 7 times there's been a new president sworn in, the market's been up all 7 times. This rally happened quicker than it has in the previous 7 times, especially in the IWM, the small cap ETF. So it now looks stretched technically. It's more than 2 standard deviations above its 20-day moving average. And the price to, even if you're bullish longer term, the price to buy some protection out a month, that it reverts a little bit lower, is the cheapest it's been since July. So I think tactically, if you have the ability to look shorter term, playing a reversion after the inauguration is an interesting play right here.
Well, not to mention the fact that anyone who's been on small caps over the past year has been kind of disappointed, right? That we've had, sort of every time there's been a move up, it's been met with another move down. So get specific with this, David. How are you structuring a trade potentially around that, hedging against some downside here?
Well, if you're thinking about downside, there's 2 schools of thought essentially. One, of course, the AI theme and big cap tech are driving the market right now. Today is the first day over the last 7 that more stocks are down than up in the S&P 500. And the market's been up 6 of those 7 days. So Microsoft and NVIDIA are accounting for about 50% of the move higher in the S&P today. So there's one school of thought saying, well, if we're going to go down, the same stocks that took us higher could also take us lower. The other school of thought is, I'm just not sure where the bottom of this endless wallet on AI is. And if I want to hedge broader market going down, maybe more interest rate exposure, I want to look at the small cap indices. And the option market really isn't respecting the downside in IWM right now. So like I said, you can buy downside puts for about 40% cheaper than the average has been over the last 6 months. So if I were going to play it, I would go out to February 7th expiration and buy the 220 strike puts. IWM is about 230 right here. And what this does is that gets me about two weeks of exposure. It gets me exposure to non-farm payrolls and FOMC, both that the market doesn't seem to be focusing on that much right now. Both of these events were pretty big down days, the previous iterations of these in December and in January. So I think buying those Feb 7th 220 puts for $1 is a cheap way just to protect yourself. You can stay long and buy those for very, very low premium.
David, so we're talking small caps. I also want your take on Apple, which we've been talking about this week. Apple's been making headlines, not for good reasons, but because we had another couple analysts downgrade that name. You have some concerns about how that business might be doing in China. What are you seeing for Apple, David?
Apple's a super interesting setup because, like you said, it's been down 15% since Christmas. It seems like analysts keep chasing downgrades, more downgrades every night, but it's interesting that earnings are next week, so they have a chance to tell the story. I think the street's expecting numbers to be not that impressive, but that's known. That should be kind of priced into the stock here. So even if you believe in the long-term multiple contraction story of Apple, I think there's room that it could bounce after this huge move lower. So if I was long Apple stock here, I would try to overlay a option structure that doesn't add risk. It doesn't add more risk to the already long position that's been painful the last 2 weeks or so, 3 weeks. But what I would do is I'd try to make some of that money back. So I'm not just trying to get back to even, I'm actually making a profit if the stock goes up 5, 6, 7, 8% on earnings. So what this looks like is a 1-by-2 call spread. So if I'm long the stock, I buy one of the Apple, so January 31st is the expiration because they report earnings on January 30th. I'd buy one of the 230 strike calls that matches my current stock position, and I would sell two of a higher strike call that are pretty expensive, 237.5 strike calls. So what this does is that essentially makes my existing stock position covered. I'm willing to sell some of my stock at 237.5, but in return, I get almost a free call spread. So I make money in this range of plus 3% to plus 10%, a very probable range for Apple on earnings, and I'm outperforming just sitting here in long stock, hoping we get above the high water mark.
David, great stuff. Thanks so much for joining us.
Thank you.
Stick around. We've got much more market domination still to come. Stocks tied to the AI trade are jumping on the back of President Trump's Stargate project announcement. For more, we're bringing in Angelo Zeno, senior equity analyst at CFRA Research. Angelo, thank you so much for joining us. This announcement bringing with it some drama in the form of Elon Musk saying, oh, they don't actually have the financing lined up for this thing. Then Sam Altman of OpenAI kind of pushing back against that. And I guess my first question would be, with the kind of magnitude of some of the gains that we're seeing with anything that's reportedly associated with this project, do you think that those gains are justified here?
Yeah, so, thanks for having me. I guess, the first thing I thought about when I saw the actual numbers, the 100 billion and the 500 billion, was I was like, these numbers are absolutely enormous. So Stargate is something that has kind of been speculated about for over a year, right? It's kind of been the vision of Sam Altman here for quite some time, and we've kind of now finally seen his kind of news come out. When I kind of look about, whether or not some of these numbers are realistic, I don't think that's necessarily kind of, what we should kind of be focused on right now. I think this is, for bulls, a very positive data point out there. Clearly, we need to see the demand side of things play out for us to kind of see any sort of numbers like this actually kind of come to fruition. But that said, listen, I think you got to be excited about it. I think you should have some doubt about, the funding aspect of all this. But nonetheless, I mean, you can always throw new investors kind of, within this, the 100 billion, 500 billion, funding rounds and what have you. So it's all about kind of seeing that demand come to fruition. And when we kind of think about 2025 and 2026, it is going to be the year of AI agents or agentic AI, and we need to start seeing a lot of the things that we're seeing right now in kind of the test phase kind of go into production. And we need to start seeing that by the second half of 2025 into 2026. And if we see that, that optimism will be there to continue to spend and spend aggressively.
Angelo, off these headlines, though, clearly, I mean, investors are placing bets. They're excited. So I want to talk about some of the reaction, the response we're seeing in your coverage universe. I look at a name like Oracle today, Angelo. It's surging almost 7% in today's trade. What do you make of that? Is that move justified, Angelo?
So I think Oracle is a little bit of a different story relative to maybe other AI-oriented names out there, specifically on the news today, yesterday and what have you. And the big reason for that is because I think what you're actually seeing, or why the stock is reacting like this, is because you're almost seeing a strengthening of the relationship between Oracle and potentially OpenAI out there. And you kind of saw the news also kind of amidst the Stargate news also that Microsoft is no longer going to be the exclusive provider for compute capacity out there for OpenAI. They do still have that right of first refusal, and you still have a very strong relationship between Microsoft and OpenAI. But that said, I think Oracle is becoming a much bigger player here on the cloud side of things. When you look at that infrastructure business, it's growing at north of a 50% clip here on a year-over-year basis. It's about 17% of their revenue. You look 2 years ago, that business was growing about 50% on a year-over-year basis, but it was only about 8% of their revenue. So when you kind of extrapolate some of the opportunities here for Oracle over the next 2 to 3 years, I think it's actually warranted to see the type of move that you've seen here on Oracle over the last 2 days.
And hey, Angela, I want to get your take on effectively what was an opinion piece that came out from the information that said, what if Oracle bought Salesforce? Now, I can, count on one hand, probably two hands, the reasons why that might be unlikely. But I was curious what you thought.
I think that's interesting. I didn't see it, but those would be kind of two massive companies out there, kind of coming together. Oracle, clearly kind of focusing more on the on the infrastructure side of things right now within kind of that software ecosystem, so more on the cloud side of things. And clearly you've got, also them as kind of a big kind of one of the big two ERP players out there along with SAP. So I can see, throwing, Salesforce in there with Oracle, some kind of synergies out there, some complementary type offerings, and, potentially creating an absolute massive powerhouse on the software side of things. Whether or not, something like that ever comes to fruition, again, all speculation and who knows. But I think it could potentially make sense if you were to see something along the lines of a combination between the two, to be honest with you.
Angelo, always good to see you. Always good to have you on the show. Thanks for joining us.
All right, thanks for having me.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's a closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session here. A little bit of a fade at the end of the day, but not much. The Dow, the weakest of the three major averages, up 130 points, still good for a gain of 0.25%. The S&P 500 up about 0.6%, and the Nasdaq up 1.25%. Lately, of course, we've also been looking at the equal weight, which is lagging in a pretty big way today, which shows us that tech is really driving the bus here. Mega cap tech, especially. Likewise, the Russell 2000. We were just talking about some hedging trades for the IWM, which is the ETF that tracks the Russell 2000. The Russell 2000 itself down about 0.5%. But of course, a lot of the discourse today, not just dominated by some of the earnings coming out, but also dominated by what we heard from Washington in terms of this new Stargate project, this $100 million project to build AI infrastructure across the U.S. And a cooperative effort between a number of companies. Now, the companies that were named as sort of contributing to it in various ways, trading higher today. You've got Microsoft up 4%, NVIDIA up 4%, Alphabet, which also, of course, is building out its own AI infrastructure, up just marginally here today. Amazon, by the way, closing at a new record today. One stock not participating in the party is Tesla, which was left out of that Stargate announcement and agreement, and Elon Musk taking aim at the financing behind it on his platform X. Sam Altman of OpenAI pushing back against that, but interesting to see Tesla down. And then the other company that's really at the center of that agreement is Oracle, and Oracle getting a big boost today, up 6.7%, and the stock is now up some 67% over the past year. So it's been definitely one of the beneficiaries of the AI trade, but sort of a stealthier one, even given its size, a stealthier one to some extent, and now really sort of taking on a more visible role in that AI trade. So interesting to see that movement as well today. Josh?
All right, Julie, it was a winning day on Wall Street, but the S&P 500 coming up short of closing at a new record despite the headlines around Trump policies. Our next guest says what really matters for investors right now, it's earnings. Joining us now is Siebert Chief Investment Officer Mark Malik. Mark, always good to see you on set.
Great to be here. Thanks.
So, let's start with earnings, because earnings season rolls on. Basically solid reports from the big banks last week. We had Netflix, rockstar. Procter & Gamble was higher today. What are you seeing so far this earnings season, Mark, and what do you expect ahead?
Well, so far so good. It's always good when the financials come out strong. I think was largely expected, but what was interesting was the response of the stocks themselves, right? Those stocks were a little bit on the rich side, some would argue, and some might have argued that there was not much upside, but the beats were solid and the reasons for the beats were solid, and that's why you saw an extension of those in that sector. I think that set a very sort of positive tone as we rolled into this week, and I think, again, what we're seeing so far is kind of what we expect at this point. Netflix always has the potential to knock one out of the park. Again, the interesting part about Netflix is it makes sense, right? It's common sense, right? It does make sense based on their recent performance, based on the content that they've been carrying lately, based on where I spend my few hours at night that I have free. It made a lot of sense. And I think that is going to set a very positive tone going forward. I think we're going to see more of that.
And we should know, by the way, Netflix closed at a record today.
Yeah.
So saw that leg up in the session, and it was enough to push it to a new record, the first of 2025, of this early new year. What does this portend for big tech earnings? I mean, we just showed the Nasdaq 100 heat map, and it's very green. Amazon closing at a record, seeing big increases in those other stocks. Are we going to see a big earnings season from them?
Well, I hope so. I mean, the interesting thing is I think that even though we are sort of ratcheting down those big numbers that we got earlier last year, the numbers are still great. And if you look at sort of the broader macro view, even just what happened with Stargate today, even who was at the inauguration the other day, I think that portends, again, some very positive upside. There's already room for upside. If you look around all the sectors, there are no other sectors that have the type of upside that is now offered by this AI ecosystem, no matter how you slice it, right? Whether Stargate is $100 billion or $500 billion, it is a nod that the administration is going to get behind that. And so all of the telltales are certainly pointing toward positive. So will the market be, look at these numbers like they may have in the past with a little bit of scrutiny? Possibly, but I think, again, the momentum is behind us. And there's nowhere else you can look for this type of potential at this point, as far as I can see.
Mark, are you in that camp, though, speaking of big tech, that sees, okay, 2025 is the year we actually see meaningful, sustained broadening in the market?
Well, I think we talked about this last time I was here. I'd love to tell you that we've seen some signals that would tell us otherwise, but at this point, it still looks like today is sort of a snapshot of what we can expect for these bigger moves forward, where tech will lead the way. The breadth is not going to be big, and you're going to see green across the tech. And I feel like unless something changes significantly, everything we've seen, certainly out of the very, very new administration, about what we expect going forward, unless anything significant changes, unless we see real policy moves, I think we're going to continue to see this type of trade, certainly through this quarter.
Well, you bring up a good point, which is how to weigh everything right now. And you wrote in a recent note to kind of like try to look through the noise that is out there, and it's a very noisy time. So, when you're weighing and juggling the Fed, fiscal policy, earnings, how do you sort of weigh all of those things?
Yeah. There is a lot of noise, and we are struggling to find signals. And you have to be really, really practical because you can't avoid what you're seeing on the tape. You can't avoid what you're reading. You have to read through those 200, those 200 signatures. But at the end of the day, earnings is always the best signal, right? Because that's the pulse. No matter what the patient looks like at face value, the pulse is what you first look for. And so if we see solid earnings, that is the most important signal to start. Of course, even in a down market, companies that are doing well struggle a little bit. But I think we have a little bit of momentum here. So I think the companies that are going to have those good signals, right, the right signals, I feel like they're going to be rewarded because I think, again, the broader market's pushing it in that direction.
Mm-hmm. Mark, obviously a ton of fiscal policy uncertainty. Is there a particular policy that you think, okay, this is the one that matters most for investors? Is it taxes? Is that what investors need to be laser focused on? Would that be it?
I think taxes, of course, are one of the clearest stimulants to the market and the economy. I would expect that we would see some stimulative tax legislation in this year. I believe that Congress, along with the president, is going to start hitting that pretty quickly because of timing-wise. I think you're going to start seeing some stuff come out of that. We already saw SALT talks, and all this stuff is starting to come out. I think that's important as a stimulant, right? But we've all been very focused on what could hold the market back, what could be problems such as the tariffs. And of course, there's a lot of ambiguity around what they're going to look like, how long they're going to last, if they're going to be there. But I think there are still some other things that are waiting in the wings that we have to be concerned about. The immigration policy, that could certainly be inflationary if not handled properly. And let's not ignore that there might be a bunch of government employees out of work really soon. We know that today a bunch of them have been put on furlough. And that is certainly not stimulative to the economy. I'd like to see how that plays out. Right now they're on paid leave, but there are a lot of rumors that these employees are ultimately going to be let go. And of course you have DOGE, which is looking to save money. Saving money is a very, very good thing when you're looking at the deficit, but it also is a drag on the economy. It's less spending on government and spending and less spending on government employees. And let's remember that government is one of the triumvirate that drives GDP. Not the largest, but still an important one that could have a negative impact overall.
A lot of noise indeed. Mark, thank you so much.
Thanks so much.
Appreciate it. Well, all week long, Yahoo Finance is bringing you conversations from the World Economic Forum at Davos. And on the other side of this break, we'll hear from Brian Sozzi as he catches up with the Carlyle Group co-founder David Rubenstein to discuss his economic outlook under Donald Trump. Be sure to scan the QR code below to check out all of our conversations and coverage from that landmark event. Stick around, we've got more market domination still to come.
David Rubenstein, Carlyle Group co-founder. Always great to see you here at WEF, David. Appreciate it.
Thank you for having me.
There's been no shortage of things to talk about coming from the new Trump administration. Are you as optimistic on what this administration will get done as basically what I've heard from every executive here on the ground at Davos?
I think most business executives are reasonably optimistic. There may be some that aren't, but basically, new administrations always produce some optimism. And now the optimism is in the business community because they would see less antitrust regulation, they believe. They would see less enforcement by the SEC, perhaps. And they would see more openness at the White House to some of the things the business community wants to do. Good example might be cryptocurrencies. So I think the business community does generally feel optimistic about what the Trump administration is likely to do. That's not to say that the Biden administration didn't do some things that were very good for business, but clearly this administration is seen by business community as much more sympathetic, rightly or wrongly.
Is the biggest opportunity for the Trump administration to extend their tax cuts?
That's an important opportunity, but that's a necessity in the sense that it's unlikely that the Congress will want to not have those tax cuts extended. As we learned, when you have tax cuts and people get used to that rate, it's very difficult to have them jump up again. So I suspect it's not something that's going to be an unexpected addition. I think the president's likely to want to do things that he hasn't done before, and Congress has some ideas as well. But that's an important part of what he wants to do. But remember, tax cut legislation doesn't have to be done probably until the end of the year. So he's going to want to do a lot of things earlier. So they'll work on the tax cut legislation, but it's got to go through the Ways and Means Committee, got to go through the Senate Finance Committee. It'll take a while.
You've extensively studied presidents. In fact, you recently wrote a book on it. Are business leaders too optimistic on what this president can get done in the first 100 days and then also the next 4 years?
Well, I don't want to say they're too optimistic or too pessimistic. I think I'm not going to characterize it. I would say there's no doubt there's a lot of optimism. And there's no doubt in the tech community they're very optimistic. Whether that's justified or not, time will tell. But you saw the inaugural ceremonies, and a lot of tech leaders were there. So you usually don't see that in inaugurations, having business leaders stand behind the first family or something like that. There's no doubt that they are optimistic and they're willing to suspend a disbelief about certain things and they're willing to go forward. I think the business community generally, not just the tech community, is pretty optimistic about this administration helping them in some ways. Time will tell whether it's going to work.
How does this administration impact the business of doing deals? How does Carlyle's business change over the next 4 years?
Well, we won't know for certain, but there's a general feeling that, one, if tax rates are lower, that's probably good. Now, the tax rates are really going to stay the same, but if they're kept as low as they are now, that will be positive. Many people in the business community and private equity would say it's good. Secondly, IPOs are likely to flourish a little bit more. The IPO market has not been that robust. It's now thought that more and more people will take their companies public. It's also thought that the stock market will probably keep going up as it has since the election. People also think the antitrust enforcement will probably be less rigorous, and therefore you can get more deals done. And people think that financing costs will probably come down as interest rates go down. So I think generally it's a very good situation the business community and private equity feel.
Someone I think you know well, Nasdaq CEO Adena Friedman.
Right, she used to be the CFO at Carlyle.
That is correct. Well, she came onto my podcast and she said the second half might be really good for IPOs. Do you share that optimism?
Well, she would know better than me about IPOs because that's a large part of what she worries about. I think that a lot of people are working on IPOs. We have a number of companies I think are likely to go public this year, and a lot of other firms do as well. So yes, I do think it'll probably be a good year for IPOs, but a good year is almost anything compared to what we've seen in recent years. There haven't been that many great
dried
IPOs.
Up. It dried up.
Well, it's also dried up for other reasons. In 1997, there were twice as many companies that were public as there are today. And that's for other reasons. A lot of people just don't want to go public. For example, Stripe is a great company.
They're here on the promenade.
Right. They don't want to go public. At least they've said for the time being they don't need to go public. They've been around for at least a dozen years, perhaps. So a lot of companies say we can get financing, we can let people liquefy their holdings, investors and or employees without going public.
What do you think about these? I did a panel for WEF on companies staying private for longer. And they're still able to raise money. The valuations seem high. I mean, have AI valuations and tech valuations, does it seem too frothy to you?
You only know when there's a bubble when it bursts. So we'll find out in time whether these valuations are too high. If you had told me 2 years ago there will be a small company based in Silicon Valley that will have a $4.5 trillion market capitalization at some point because they're in artificial intelligence chips, I would say you're crazy. But that's what's happened. So there will no doubt be other companies like this. I won't say their valuations are too frothy, but I do think that artificial intelligence will take some time before people see the profits associated with it actually being realized.
David Rubenstein, always good, always good to see you. All right, do stick around. Much more ahead on Yahoo Finance.
President Trump announcing a new $500 billion AI project called Stargate. It's a private sector investment in infrastructure for artificial intelligence.
This is, to me, a very big thing. $500 billion Stargate project. I think it's going to be something that's very special. It'll lead to something that could be the biggest of all.
With a project of such massive size and scale, the potential for new cybersecurity threats could also loom large, and opportunities, perhaps, for those who fight them. We're bringing in Sanjay Poonen, CEO and president of Cohesity, which is a privately held cybersecurity company. Sanjay, thanks for being here. So, at this moment where we are seeing this huge interest in building out that AI infrastructure in the United States, kind of what role does cybersecurity play, and what role do you guys specifically play?
Thank you, Julie, for having me. Yes, I think it's an exciting time. We're optimistic, just like you heard David, and I think the business leaders speak about the new administration. We know several people there, and we're hopeful that the private sector and the public sector can continue its strong work to keep the country's data and the world's data safe. We are focused on protecting the world's data. And a lot of these projects, whether it's Stargate or others, are based on AI of large amounts of data. What we do well is protect the world's data and provide both tools to secure it from ransomware attacks, and the nation-state actors are alive as always, but also provide AI tools. NVIDIA is an investor in us. SoftBank's an investor in us. So we will participate in many of these projects that emerge. Stargate's one exciting one. There'll be many more to protect the country's data.
There was, Sanjay, this very interesting theme that had been developing, and we were talking about this on the show today, of investors maybe starting to question all this spend, and where the return was. But obviously, a lot of enthusiasm. So I'm just curious how you think about that question and that dynamic.
Well, I think it's the private sector spending. I mean, this is not the $500 billion here or others. It's going to be the private sector raising money, whether it's SoftBank or others. And I think there's been a little bit of capital on the sidelines. But as interest rates go down, there is capital to be had as we raise money. As you know, we did this acquisition that took us from number 7 to number 1. We raised over $3 billion. And there was a lot of interest in our company from investors because there's money that we want to deploy in this area. So I think the attitude of investing, whether it's from private equity or venture capital, late stage funds, is high. And this is an area that does require investment. The data centers and things that are required in this area, GPUs are not cheap. So the investment's actually a good thing for this country. It will create U.S. jobs, and I'm pretty excited about that. We're excited about hiring people in the U.S., young engineers. So this is good for the United States. And I think as a citizen of this country, to see investment like this happening from large, important capital investment players is really, really good.
Sanjay, what does it do to the so-called threat surface, right? What's the vulnerability of, say, a physical plant, a physical AI data center versus the cloud versus some of the other advancements we've seen over the past few years?
Well, Julie, it's a good question. As the surface area of anything increases, so does the threat landscape. So we protect hundreds of exabytes, the most of anybody in place. Now is the number 1 player in this, over 12,000 customers at 85% of the Fortune 100. And we're talking constantly to them about their threat vectors. We have Kevin Mandy on our board, who is very involved in all the big cyber fighting in this country. And we also have a very strong federal business, both in military and civilian. So I'm often looking at every threat. We announced a few weeks ago a cyber emergency response team, like an incident response team, works very closely with Palo Alto and CrowdStrike and Mandiant. So we think that the threat surface here is going to increase. But what I'm excited about is this country's got some best cybersecurity minds that's going to fight the bad guys. And we have to be right all the time. They have to be right only once. But I do believe the security industry in here and in countries like Israel and other kind of key countries are working together. We can ward off, and we're going to continue to learn. Now, what we do is ransomware protection. So we assume you're going to get hit, and then we recover the data fastest of anybody. That's an important aspect in the recovery and remediation process, not just the detection and prevention piece of security.
Sanjay, you all do business in China, so I am curious, how do you see the U.S.-China relationship evolving with Trump now back in the White House?
We chose, as we acquired Veritas, not to acquire the China entity. We felt that was right for the U.S. We do have engineering in India, but most of our investment is in the U.S. We're a U.S.-centric company. We do have business through distributors in China. It's an important piece of it. We're cautious. I have not had a great, kind of watching this from my days at VMware, of seeing IP protection there. So if I think the U.S. is wise, and when I talk to my tech counterpart CEOs, to be cautious about IP and about being able to do fair trade, China is a competitor of ours. And we've not often seen great success from Russia, China, Iran, North Korea in nation state attacks. But we're optimistic that, if peaceful relationship and IP is protected, that we would like to do business like any other tech company. So we'll be following what happens in the cybersecurity area, in AI, in working with all countries. Most of our business is in NATO-friendly countries today.
Sanjay, in terms of threats from China, we, in the first Trump administration, when we first started seeing, trade war tensions sort of rising, did we also see a commensurate increase in cyber attacks from China? Do we see any kind of parallel between that?
In the last 4-8 years, there have been increased attacks mostly from Russia and some other countries, but China is on the radar of many of the cybersecurity folks that we work with in the government, and you have to be on the alert. And, the nation state is sort of the top level, but then when you go below it, there's e-crime and just sort of people just hacking their way into it. A little bit like you see these like drones today that can be very cheap to build. Cyber attacks can be very cheap to build, and AI actually helps you build them faster. So we've got to be on the alert for any of these bigger nation states who have military constructs that can fund many of these efforts. But many of them are also just sort of notorious gangs that now learn from that and can easily. And the good news is I think there's focus on this. We've got to take care of our infrastructure, whether it's electric plants, nuclear plants, electricity, water, all of those stuff. But then every industry, whether it's financial services, retail, healthcare, we work a lot in healthcare. Hospitals are getting attacked. We've got to make sure that our healthcare records, schools, many school districts are getting attacked. And we find this cause of protecting the world's data a very, very noble cause to ensure that we keep everybody safe from cyber attacks going forward.
Sanjay, finally, as you alluded to, you heard that conversation between our Brian Sozzi and David Rubenstein where they were talking about the many, many companies that have decided to stay private and not to go public in this market. I'm curious about Cohesity, what you guys are planning. Are you content to stay in the private markets for now, or do you have a plan to go public at some point?
Well, Carlyle is an investor in us, and David knows us pretty well. We chose to do this deal. So as you know, this was the most iconic deal. Number 7, Cohesity acquiring number 2, Veritas, to create a new number 1 in this place, Cohesity. And we chose to do this deal and wait. And we didn't feel last year was a great environment to go public. We think this year and next year will be. So certainly doing an IPO is on the radar. It's not the destination of any company. It's a milestone. And we are the most profitable company. We're getting close to about $2 billion in revenue. We're the most profitable growth company in our sector and number 1 with a strong base. So we will be public ready when we're ready. But for the past 12 months, we decided to do this deal, digest it, and then we'll be ready. And it's much better, I think, to go public as number 1 in this space rather than number 7.
Sanjay, always great to see you. Thank you for joining us.
Thank you, Josh.
Time now for What to Watch Thursday, January 23rd, sponsored by Tasty Trade. Starting off on the earnings front, earnings season is heating up, and we're going to see more reporting from GE Aerospace, American Airlines, and Alaskan Airlines. American Airlines announced the results for the fourth quarter before the opening bell. Pressure is on for American Airlines after United and Delta posted solid quarters of their own. Analysts expecting the company to follow suit with a strong Q4 boosted by lower fuel prices and its recent credit card deal with Citi.
Taking a look at the labor force, weekly initial jobless claims data coming out in the morning. Economists forecast weekly claims will come in at 220,000 for the week ending January 18th. That's a slight increase compared to the week prior.
And moving over to housing, mortgage rate data for Freddie Mac coming out in the afternoon. Current rate on the 30-year fixed surpassed 7% last week for the first time since May. It was also the 5th straight week of increases.
And all week long, Yahoo Finance is bringing you conversations from the World Economic Forum in Davos. Let's get you back out to Brian Sozzi for what investors need to be watching from that landmark event on Thursday.
It may be cold at the World Economic Forum in Davos, Switzerland, but it is hot, hot, hot on Yahoo Finance in terms of coverage and headlines from this market-moving event. Let me tee up our Thursday coverage here, because frankly, I'm blown away. I'm just blown away thinking about who is going to come grace our set. First up, Antonio Neri, HPE, that is Hewlett-Packard Enterprises, coming by our set to talk about the future of AI. Also, Antonio still trying to close a very important deal to his company. We'll ask him more about that. The CEO of HP Inc., Enrique Lores, coming by to talk about the future of AI PCs. When are they hitting the market? How much will they cost? That is ticker symbol HPQ on Yahoo Finance. I always want to point these differences out between HPE and HP Inc. Also talking about the future of industrial policy in the U.S. and around the world with Honeywell CEO Vimal Kapur. Vimal also smack in the middle, potentially breaking up this iconic global company. Fascinating stuff happening over at Honeywell. Also looking forward to catching up with Morgan Stanley CEO Ted Pick. Still relatively new in the job, but no stranger to Morgan Stanley and helping to reinvent the company. Jacked up to welcome Ted to the Yahoo Finance World Economic Forum set for the first time. And we're going to drop the mic on our coverage with returning Yahoo Finance guest Ron Kruszewski, longtime CEO of Stifel, one of the longest serving CEOs on Wall Street. Excited to hear how Ron is thinking about where interest rate policies might go, what it might mean to markets, what deficits might mean to markets. Lots going on Thursday's coverage at Yahoo Finance. Be sure to tune in on the Yahoo Finance platform, the Yahoo Finance app, the World Economic Forum hub on Yahoo Finance, and of course, major podcast platforms, YouTube and streaming TV.
Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Another good day for the markets, with tech stocks and the Nasdaq at large getting a boost from President Trump's $500 billion AI push, dubbed Project Stargate. We're going to dive into the rest of today's market trends. Then we're going to take a trip to the World Economic Forum in Davos, Switzerland, and hear from PepsiCo CEO Ramon Laguerta, find out why he's eager to change the minds of food industry critics inside the new Trump administration. Plus, President Trump is promising to bring manufacturing back to America. Can he do it? I'm going to sit down with the National Association of Manufacturers CEO to get his feelings on what the president has said so far. Well, fourth quarter earnings season off to a solid start while the S&P 500 notches its second highest close with more big tech earnings and fresh economic data ahead. Paired with policy uncertainty from President Donald Trump, the coming weeks will pack a punch for investors. Here to discuss is IG North America CEO JJ Kinahan. JJ, it's good to see you. So,
good to see you, Josh.
Listen, another day in the green, JJ. It's interesting because you look under the market, you say under the hood, you see some encouraging signs. What would those signs be, JJ?
Well, the biggest thing would be the fact that we are having a widespread rally. This is not a Magnificent Seven rally. This is a rally across the S&P 500, and I think that that's the most encouraging thing I see, Josh. You know, you look at a stock like Apple. Yes, good day today. Stumbles yesterday. Not one that, you know, is really out front, which we've seen so often in the past. And in a Microsoft, same thing. So in general, you are seeing people buying across the board. What I love about this is off earnings, the financials have really come to play, if you will. And for us to continue to have a strong rally, again, financials, which if you remember the last rally, was all about technology. They're still the second largest group in the S&P 500. So the fact is we're seeing other technology besides the S&P 500 perform, while at the same time getting the financials to perform. To me, that's a very, very bullish sign longer term.
Are you in that camp, JJ, that says, okay, we're going to see this kind of meaningful, sustained broadening in the markets in 2025? I was speaking today to another strategist, and frankly, he didn't sound that confident that was going to happen. Although honestly, it didn't seem to worry him all that much either, JJ.
Yeah, you know, I'm not worried about it, to be honest with you, Josh. I do think that we can continue to perform now. That said, as you're reporting on every day, this is going to be a particularly next few months where I think we face a few curveballs in terms of what is actually going to be enacted by the president. You know, there's been so much anticipation about what's about to happen. Now that we have the president in, we still have to get what are going to be his primary priorities. I don't think that's actually completely clear yet overall, you know, where will tariffs fit in, et cetera. So I think hopefully we'll have a better picture over the next month or so, what's truly going to be the priorities. And that may change certain industries, et cetera, or what's considered good, what's considered bad in terms of what you want to hold. But I'm not particularly concerned about it because, you know, a lot of people have talked about regulation. And I think one of the things about regulation is people aren't saying let's have less regulations. I think what people are saying is let's have less red tape. And that is why we're seeing such a energy around these earnings, et cetera, and why the CEOs are so positive when they're talking, because what they're really saying is not we're having less regulation, but the red tape in order to get things done is about to be cut pretty significantly.
And I also want to get your take, JJ, another dynamic, the strengthening dollar. Obviously, CFOs are going to do their best, try to hedge that. But what are the ripple effects, the implications, JJ, as you see it playing out?
I don't see them playing out for the rest of this earnings season very significantly. But what I do say, Josh, you know, it's kind of weird to say we're already talking about next earnings season, but it would be surprising to me if a lot of these multinational companies don't start saying, hold on, it's very difficult to sell in Europe. It's very difficult to sell in Asia because the dollar has absolutely, you know, you look what it's done to the British pound. It's absolutely ripped through some levels over the last few weeks. And if it continues at this torrid pace, it is going to affect sales longer term. There's just no two ways about it. To me, when you ask, you know, about what are some of the questions in the economy, the biggest question to me is how do multinationals continue to compete if the dollar is strong? And if we have any kind of tariff program at all, again, it seems to be very unclear right now as to what's happening. That could have a very big effect on some of these companies.
One theory I've heard, JJ, talking about Trump, I'll get your take on this. I've had some policy analysts come on and say, listen, they ultimately expect, and granted, to your point, we're still waiting. What exactly are the policies? What shape do they take? But some of them said they actually ultimately think that the policies will be more modest, modern, orthodox, and maybe a lot of the bark would suggest. In part, they say that, JJ, and here's their case, because they say Trump really does look to the stock market a lot. He holds the stock market up as this kind of report card on an administration's success or failure, and ultimately he just is not going to want to rock the boat too hard. Do you buy that, JJ, as an argument?
Well, I do think there is something to it. Let's recall the news flow last time President Trump was in office, and that is he did reference what the stock market was doing quite a bit. I think one of the other things that people may have forgotten is he has a tendency to use his statements almost as a point of negotiation to start. So we'll make a broad statement to get started and then eventually start to bring that back. And so I think that people have to keep that in mind, that first initial statement is not normally what ends up happening, but there is certainly nuggets of truth in that statement, but also some hyperbole around it. So with that, I do believe that he definitely does seem to look at the stock market and reference it when things have gone pretty well. And so his last term, things overall went fairly well. So that doesn't surprise me. I don't know that I'm going to say that he looks to that as his only guidepost, because I don't think that's necessarily being fair. But the other thing I will say is he does have some very smart business people around him who know how to perhaps influence things that can be more favorable for companies.
Yeah. Besson, Lutnick, these are pro-business, pro-market guys, JJ, to your point.
Absolutely.
Thank you, sir. Thank you for joining us.
Good to see you, Josh.
Good to see you. Coming up, we'll get you back out to the World Economic Forum in Davos, Switzerland, as Brian Sozzi sits down with the CEO of PepsiCo. Stick around, much more Ask for a Trend straight ahead.
All the big name CEOs are here at the World Economic Forum in Davos, Switzerland. And one of those big names, no stranger to Yahoo Finance, that is PepsiCo CEO Ramon Laguarta. Ramon, always great to see you. I appreciate it.
Great to see you, Brian.
Are tariffs a threat to your business? For those investors not familiar with the PepsiCo model, they they a big
Of
risk?
course, we could be impacted, but I would say to a very small extent, because we are a company that is local for local. The fact that I was saying earlier, we're mainly an agriculture company, and we source most of our crops from the local markets where we service consumers. So you should think about us as potato being grown in Turkey to serve the Turkish consumers, or potato being grown in England to serve the English consumers. So that's the nature. We have some parts of our business that are being exposed to international movement of raw materials. It's a small part of our business. We've been working obviously on resiliency of our supply chain. Geopolitics have been important in the last few years, as you can imagine. So we've done a lot of work on becoming more resilient, more local, having more supply chains that can stand different disruptions that may happen around the world.
Is it harder today to be a public company, global company, compared to 5 days ago when President Biden was still in the House? I mean, I'm hearing so much concern about global trade wars.
Listen, I am hopeful that the current administration will help us close some of the big wars that we have today in the world. So both, the stability of the Middle East is very relevant for us as a company. We have a big business in the Middle East. And also the Ukraine war is impacted us. We have a lot of associates in that part of the world. And so I'm hopeful that there will be a new energy, new ideas coming into play to close down those two very negative events for people, but also for businesses and communities.
We talk every time you report quarterly earnings. It's by phone. It's not here in the World Economic Forum in Davos.
Good to see you.
Yeah, likewise. And we've talked a lot about U.S. lower income households under pressure still. How much under pressure are they, and do you see them at all starting to turn the corner?
Two things. There's clear bifurcation in the U.S. between consumers that are doing well, and we can see them spending more in elevated experiences, entertainment, and traveling, and there's been a very good end of the year Christmas season for a lot of those consumers. We continue to see the lower end of the pyramid having problems to get to the end of the month, and that is a reality. We're hopeful that with inflation being under control, I would say.
It is under control?
It is in levels that are very manageable for companies like ours. We're used to this 2 to 3% level, and I think through productivity and other initiatives we can minimize the pricing. So I think we're in a much better place. So we're hopeful that with inflation being at a much lower levels, unemployment being so low around the world, so clearly everybody has a chance to work, majority around the world. Those two elements will help the lower income families improve their confidence and improve their ability to fulfill their dreams in the coming year.
Do you worry that this administration targets packaged food?
Listen, again, it's not a worry. I think we've been leading the transformation of the food industry for many years. I mean, we've been leaders in sodium reduction. We've been leaders in sugar reduction. We've been leaders in eliminating fat from products. We've been actually in artificial colors. We've been leading. We don't have red dye 3 in our portfolio in the U.S. I would like for us to be also working with the new administration on how do we move forward eliminating artificial colors from food in the U.S. And I think it should be science-based, it should be very pragmatic, because we're going to have to build, as an industry, alternative supply chains for some of the the colorings, natural colors that would go into food. But I would say we as an industry should aspire to, in 3 or 4 years, no artificial colors in food. It should be across out of home consumption, in-home consumption, and make it in collaboration with the new administration. It is ambitious. I think it is doable, and it should be a private-public cooperation that drives that outcome, which would be very good for the American consumer. But it has to be a level playing field where we all make a move in the same direction at the same time, and that's what sometimes is difficult. It has to be well orchestrated, pragmatically implemented, because supply chains need to be built at scale for the scale of the U.S. market, which is the largest market in the world. So it's not easy. It's not impossible. It needs cooperation. It needs public and private good understanding, and it needs some leaders, like we're willing to be those leaders that make them first moves.
PepsiCo CEO Ramon Laguarta, always a pleasure to see you.
Thank you very much,
it.
Brian. Thanks.
All right, thank you so
Cheers.
much.
President Trump has been talking about a manufacturing renaissance in America. We've got a special edition of Chart of the Day looking at a few charts that tell the story of the state of manufacturing. And Yahoo Finance's Julie Hyman joins now with a closer look. Julie.
Yeah, sort of what's the baseline here for this manufacturing renaissance that we talk about and that President Trump has talked about? Yesterday, we talked about foreign investment in the United States in projects, which right now is at a record when you look around the world on a comparative basis. But I wanted to look at a number of other charts, just sort of set the table here for where we are in manufacturing in this country. So first up, looking at U.S. manufacturing employment, which stood at 12.9 million manufacturing jobs at the end of last year. And you see here, this chart looks at the flow of manufacturing jobs through various administrations. Now, we saw a big drop sort of post-financial crisis here before a bit of a recovery going into the pandemic. And that recovery, by the way, was pretty agnostic to administration, whether it was Republican or Democratic, as we see here. Of course, there was a big drop during the pandemic. And since then, we have seen manufacturing come back up to the levels where it was pre-pandemic, helped in part by some of the stimulus, of course, that has gone into the U.S. economy. But I also wanted to put this in perspective a little more and look at manufacturing jobs as a percentage of all jobs in the United States. And there we have seen a pretty steep decline. Now, any student of economic history knows this, right? We are less of a manufacturing economy in terms of what people do than we were, say, in the 40s and 50s and really going into the 80s when the current decline began. But it's been pretty steady here since the financial crisis at around 8 to 10% of all employment in the U.S. And then finally, looking at GDP, manufacturing as a percentage of GDP, this just goes back to sort of the pre-financial crisis period. And even though this looks like a pretty big decline, it's about a 3 percentage point decline. In other words, from around 13% back in 2005 or so, going down to around 10% currently. So, you know, there's obviously a lot of color, a lot of detail to what President Trump is trying to accomplish on this manufacturing front, what kinds of manufacturing jobs will be added. This big AI infrastructure project was just announced. So it's going to be interesting to see what these charts look like 4 years from now, Josh.
All right, thank you, Julie. Well, according to European Central Bank President Christine Lagarde, Donald Trump's mission to bring manufacturing back to the United States by increasing trade barriers is a questionable approach, since the economy is already running near capacity. Lagarde saying in a new interview at the World Economic Forum in Davos, Switzerland, this theory of substitution, in other words, that I will lower imports from Europe to beef up manufacturing at home, is questionable because the U.S. economy is almost running hot at the moment. Well, joining us now is Jay Timmons, National Association of Manufacturers CEO and President. Jay, it's great to see you. Let's start there. Christine Lagarde talking about Trump's approach here when it comes to manufacturing. Questionable. What do you think, Jay?
Well, look, I think the bottom line is Donald Trump wants to strengthen manufacturing in the United States. And look, I represent manufacturers in the United States. So I want to see that happen through investment and job creation and wage growth. But I think we have to realize that we are in a global economy. There's no question about that. 95% of our customers, Josh, reside outside of the borders of the United States. So there will be trade flows globally, and we want to be a part of that mix.
You'll hear this argument, Jay, and I want to put it to you as well, and you'll hear it on Yahoo Finance, and some will say, listen, manufacturing jobs, they left the United States, they went to China, they went to Mexico, they're not coming back. This economy, it's evolving, it's turning more high tech, they're not coming back, we shouldn't look for them to come back, it's a new economy, a new era. What is just your response to that kind of argument, Jay, which I'm sure you hear a lot?
Well, in a word, bold. I mean, look, if you have the right policies in place to reduce the cost of doing manufacturing in the United States, what's going to result from that? You're going to see more investment. You're going to see more job growth. We saw that, and also to provide more opportunities to sell our products. So I like to look at this as a continuum, and I liked your charts that you put up here just a few minutes ago. I look at it as a continuum dating all the way back to Ronald Reagan. If you think about Reagan and Bush 41, and Clinton and Bush 43 and Obama, they really were negotiating trade agreements that opened markets to manufacturers in the United States overseas. And then Donald Trump came in that first term of his, and he unleashed, really, I think, the power of the economy and the ability for manufacturers to invest with those historic tax reforms as well as regulatory reforms and certainty. President Biden came in and gave us another boost with infrastructure investment, the CHIPS and Science Act, and even some of the policy provisions of the IRA. Now President Trump comes back, and I can see unleashing more ability for us to invest and grow jobs here with the extension of those tax reforms as well as more regulatory certainty.
I'm curious, Jay, have you been talking to the Trump administration? What have you been telling them, and how receptive have they been?
Well, actually, it's been a two-way conversation. President Trump spoke to our board of directors in September when he was a candidate for election. And his commitment was to do exactly that, reduce the cost of doing business here, make it easier for manufacturers to invest and grow jobs in the United States. That is welcome news, quite frankly, because we want to see manufacturing expand here in this country. And our message has been, basically put us in the game, coach, because we want to help get the extension of the tax reforms across the line in Congress. We produced a study, I believe we released it last week, with the House Ways and Means Chairman Jason Smith, as well as the Senate Finance Chair, Mike Crapo, that showed the impact of not renewing those tax reforms, which was actually a 6 million job hit to the economy and some other rather negative economic consequences. So we have that study out there to give some data and some research to members of Congress as they make these important decisions.
It's a big, important topic, and it impacts a whole lot of Americans, Jay. Thank you so much for coming on the show today. Appreciate it.
Good to be here.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.